China funds soar as coronavirus concerns intensify in a surprise twist. China funds topped performance tables last month as concerns over a coronavirus slowdown weighed on investors, wiping trillions of pounds off markets.Seven out of 10 of the best performers in February were China funds, including Matthew's China Small Companies, which generated the highest returns over the period, 12.6%. Barings and Gam had 2 China funds each in the top 10, with the pint-sized $25.4 million, £19.79 million, Barings China Select fund snagging the third top spot, while Franklin Templeton's $392.7 million China fund also featured.Funds, February 2020. Top 10 return % Matthews China Small Companies plus 12.61 Threadneedle Property plus 7.1 Barings China Select plus 6.81 NB Uncorrelated Strategies plus 6.5 GAM Multistock China Evolution plus 6.16 GAM Star China Equity plus 6.1 Barings Hong Kong China plus 5.87 Templeton China plus 5.73 Fidelity China Opportunities plus 5.68 PIMCO GIS Euro Long Average Duration plus 5.57 Source, Fundinfo'Peak Anxiety in China Peter's outFairview investing consultant Ben Yearsley said the strong showing from China funds was a surprise and counterintuitive considering the massive impact the coronavirus had on markets last month. While the outbreak has weighed on markets since mid-January, they have begun reacting more violently recently as the number of cases across Europe, the Middle East and Asia has risen. Around $5 TRN was wiped off major stock markets in the final week of February alone, with the FTSE 100 shedding £200 billion. China was the surprise performer last month, though, for context, it was one of the worst in January, Yearsley said. The actions of the government appear to have slowed the spread of the virus and add in the announced stimulus measures, and it's no wonder investors are looking to the future already, he added. It is quite likely that spooked developed markets will follow a similar pattern once the spread of the virus is under control. In other words, a V-shaped market fall and bounce is quite likely. Tilney Managing Director Jason Hollins said that while new infection rates in China had slowed and the nation was getting back to work, the same could not be said for developed markets, which have seen a surge in reported cases. What the performance data suggests is that peak anxiety with regards to the epicenter in China may now have passed, but the focus has firmly shifted towards the potential disruptive impact in developed markets where the sell-off has been broad and indiscriminate, he said. UK equities slump continues as coronavirus-related volatility increased. Fixed income funds continued to dominate. 4 out of 5 of the top YA categories last month were bond sectors, with the UK index-linked gilts beating out China/Greater China, returning 3.1% on average, against the latter's 2.8%. UK equity funds continued to slump, accounting for 3 of the 5 worst YA sectors. For more on this story, visit the news article link.